To recap a rough week in the markets, I'm joined by Justin Kuczmarski. He's the president of NAV Valuation and Advisory, LLC. Justin, what a volatile week for financial markets. The worst week for the Dow since March of 2023. What do you make of it?
Well, Asieh, thank you first and foremost for having me on. I think when you look at the headwinds facing the market right now, you have a conflux of uncertainty. I think uncertainty on where Trump is going to go. Is he bluffing? Is this a negotiation tactic? When you look at fundamentals, particularly the retailers that I mentioned earlier, the credit card data, people making over 100,000, the amount of delinquencies of payments up to 90 days has doubled in the past 2 years. So when you really look at the consumer, which always powers 2/3 of the economy, the consumer's been faced with inflation. There's uncertainty. Obviously, there's a deluge of workers worried about their job prospects. I think it's almost a perfect storm of uncertainty that we haven't seen when interest rates are low and asset values are across the board up in the past 2 years, particularly the Magnificent Seven and tech stocks.
And of course, President Donald Trump's tariffs and his trade war igniting fears perhaps of a recession. That's not helping matters any, is it?
No, I think you look at Europe. Europe has already, in the past 9 months, raised the opportunity for growth by lowering their ECB rate from 4 to 2.5%. So Europe has made the cuts. The U.S. has not really positioned themselves for the growth they're talking about. Scott Bessent, the administration, has been talking about a long game, sort of like a repositioning, a rebalancing. But are consumers really ready to go through the hard times for that future growth? I think that's the key question that you pose. Is the rebalancing something that America can take for the next 12 to 18 months?
Justin, consumer confidence at a 29-month low, I should say. People are clearly worried. I know people who look at their 401k plan every day. Probably not a good idea at this point. What do you tell these nervous investors who have their entire savings in 401k?
I think it's an excellent question. The long-run investors is to obviously hold and ride out the waves. But when you look at the growth in the past few years and you look at the uncertainty, I think the play right now, a lot of companies that were overlooked in the past 2 years, dividend-paying entities, utilities, power stocks. Everyone's been all about AI and tech the past few years, but what's going to power all these great tech plays? Energy, gas, utilities. They are trading at 4% dividend yields and healthy but not overpriced PEs of around 19, 20. Duke, Southern Company, Exelon. So when you look at those companies and you look at tech stocks that have PEs that are double that, 40, 50, 60, are rebalancing but keeping within equities to more mature companies that pay out healthy dividends is not a bad play if you're staying in the market.
What about interest rates, Justin? Are you expecting another drop anytime soon?
I think that's the key question, and actually a question everyone has posed to answer and analyze. When you look at the money supply, M3 went up from 6 trillion, from 16 trillion to 22 trillion from 2020 to 2022. That money has not left the system. So when you listen to the wording coming out of the administration from Trump and Bessent, will we have to face hard times to sort of put a break, not a Volcker 1981 hard stop, but a break on the economy for rates to come down? I think that's the big question. The U.S. has only lowered the Fed fund rates from 5.3 to 4.2, a much lower 20% drop in the past 9 months comparison to Europe, which has dropped their rates from 4 to 2.5%, an aggressive 40% drop. So I think the U.S. has a lot to go, but they're watching the inflationary data and tariffs. If they do kick in April 2nd, and it's really a hard factor on the economy, it's one to watch in the months ahead.
All right, Justin Kuczmarski, thank you very much.